Okay, so a swinging market, as you can see here, obviously this is perfect PowerPoint slide, but we're looking for higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. So this here is a swing high, swing low, swing high, swing low. These also can be seen, as you'll see in later slides, as that this would be a resistance point, this would be a support point, this would be a resistance, this would be support. Okay, support is an area, a very clearly defined area where the market has been sold off from. It comes down to a level and it finds sort of like a floor. Now, if it doesn't reverse immediately, it at least finds it very, very difficult to get through, and it will consolidate along that level. Okay, so that's what support is. Resistance is sort of like a ceiling in the market. So the market rallies up to a point, and it gets up to that point, and it can't get through it, and it will either reverse completely or it will consolidate around that point. And we're looking for the most obvious levels. Okay, everything that we do when we're trading, we need to be trading on the side of the market where the big money is. Okay, so there's no point in us trying to find these hidden levels of support and resistance that don't exist to the rest of the market, because that goes against everything that we're doing. What we're trying to do is find the areas where the rest of the market are paying attention to it and sort of ride on their coattails. So why do I like support and resistance? Well, first of all, it's probably the most basic but yet effective form of technical analysis. Everything that we do with our trading is based around support and resistance. It is the key technical tool that we have. They can be accurate on 5 minutes. They're more accurate the further you go out, but you can trade intraday levels as well. All right, so definitely on the 5-minute chart, you can see intraday levels of support and resistance. Most market participants acknowledge these levels. Okay, and as I was saying before, it's a very effective form of technical analysis. If you held a gun to our head and said, you have a chart and one tool, what would it be? Without a shadow of a doubt, it would be a horizontal line. That's, we feel we could be profitable with just literally a horizontal line and absolutely nothing else. So that shows you the belief that we have in support and resistance. Now, just going to the question, Jack, you had about, are these levels accurate on a 5-minute? Yes, they are. As you can see here, the bigger the time frame, the more important the potential support or resistance level is. So on the shorter term time frames, you can definitely trade from those levels. You just got to wait for a reaction. And this is the secret from our personal perspective. The secret with support and resistance is not to try and predict what's going to happen. Okay, you can anticipate where the market will turn around, but you then need to react to price action. You need the market to tell you that, okay, this level here, we're paying attention to this level, and therefore you can pay attention to that level. You don't want to just, let's say, for example, you're looking at a resistance level. You don't want to be selling that resistance level as the price is coming up into it, okay, because what you're trying to do there is literally stand in front of a train, and you don't want to do that. So we want to start selling when we can see weakness in the market. And there's no weakness in the market when the market is rallying. So whilst the market is rallying up to a level, you sit on the sidelines, you wait for it to show its hand. You wait for the market to stall at that level. And once it's stalled at that level and starts to roll over, that's when you look to get into the trade. Okay? With regards to risk reward, as Yusuf just asked, risk reward, typically we like a positive risk reward. So we're looking for anything, well, obviously 1-to-1 is a minimum, but we like to have, sort of like 2-to-1s on our side, because that gives us a nice warm fuzzy feelings inside that we can be wrong more times than we're right and still come out ahead of the market. Not ahead of the market, but ahead in our account. Okay? So as I said, price reacts to these levels, so movements can be anticipated. So what I mean by this is that when you look at your charts, you need to do your analysis either the morning before you're about to trade or the night before, and literally put these levels onto the chart. So you almost build a trading plan. So you almost have a plan in place so that you know when price gets to this level, if it then gives you the sort of shows its hand to you and indicates that it's going to roll over, then you can trade from that level. All right, so you anticipate the level that the price is going to react to, but then you wait for that reaction. All right, because one of two things are always going to happen at support and resistance levels, and this is something that's quite hard for some traders to get on board with. Obviously, price will reverse, which is what we're looking for. If we're in a trend and we're looking to sell the rallies, we're looking for price to reverse at these levels. But at the same time, at these support and resistance levels, price can break through with massive momentum. Okay, and what that ultimately means is you need to understand when you're entering into a trade, sometimes it feels like, you know, there's a little man inside your computer screen that's just waiting for you to enter, and as soon as you enter, he goes against you or she goes against you. The reason that it feels like that is when you're trading from these support and resistance levels, as I said, there's only really one or two things that's going to happen. It's going to reverse, or it's going to smash through it with massive momentum. And the ones where it breaks through it with big momentum, they're the trades where you feel like you've literally just got into a trade and the market has completely faded you. Okay, so it's important to keep that in mind psychologically when you're trading these levels. You know, the market doesn't have anything against you. It's just the very nature of those levels. That's what's going to happen. Does that make sense to you all? So, those little gremlins. So one concept that I want you guys to really understand here, and that is previous support can become resistance and previous resistance becomes support. Because that is the core of our trading technique. Everything that we do, we're waiting for the market to break through a level, come back to that level, retest it, and sell off from that level. Okay? That is you can't make this stuff up. You take a look at any of your charts and you'll see this stuff play out time and time again. All right? So what you have here is you have the market moving up. The market breaks through a level, it comes back to a level. That previous level of resistance now, you're looking to that level to become support. So you can actually, let's say for example, you cover up, you don't know this price action is here. You still project this horizontal line into the future because that's where you're going to anticipate the market is going to come and turn around at if indeed it gets down to that level, you know, at any time in the future. All right, that's why we said the horizontal level of support and resistance is the absolute best level because it allows you to project into the future where you believe price is going to turn around at. So then obviously you wait for the reaction. And this is an example of that in action here. So this is an Australian dollar chart for the year of 2009 pretty much. And as you can see here, it starts off at the low there. I believe that was around 80-ish or something, maybe below there, 60, 70. Breaks through that level, comes back to that level, treats it. So that was resistance there. It treats it as support. It comes up to a level, finds resistance. You put a line along there. You see it finds support here very, very briefly, rallies off from that level, comes back to that level. And again, that previous level of resistance is now support. The market breaks through this previous level of resistance, comes back to it. And where does it find support? At that previous level of resistance. Now, this is obviously an example chart. It's a little bit clearer on this chart to see than maybe some others. But this is just to illustrate to you what it looks like and how this stuff works. Okay, so if you're going to be patient enough to wait for the right price action, then you're going to be getting into the right trades. If you're deciding to trade from, let's say, like the middle of this chart here, where there's absolutely nothing for you to trade from, then you've only got yourself to blame when you get stopped out of a position. Okay, if you can wait for these levels where the market's broken through, clearly it comes back to a level that's very, very clear, and then you trade from that level, then you're going to start to stack the odds in your favor, and hopefully if you get enough of it in your favor, then you're going to be taking profitable positions, which over the long run will make you money. Okay, and you have to remember as traders that this really is a marathon. It is not a sprint. There's no prizes for the first person to get into a trade. All right, and we can't predict what the very next trade is. So every single trade, if you take it in isolation, is pretty much random. It's only a series of trades over a long enough period of time that you get to start to be able to see patterns and you start to see an edge play itself out. And that's very, very important to remember when you're trading. These are regular candles in front of you. Yeah, these aren't range candles, but we use them on range candles as well. It's just to give everybody an idea of this is sort of like a general support and resistance webinar. How about if the day chart is uptrend, but your 4 hours downtrend, which will you follow? Well, ultimately, the longer term time frame takes precedence, so you'd go with the daily chart, but you'd really look to see where you're at in the grand scheme of things. So, for example, this is a daily chart here, okay? This is a massive uptrend. You could look on a 4-hour chart and you could see this is a downtrend here. We would be looking for a reversal on the daily chart, and we could possibly look for like a 1, 2, 3 reversal, some sort of price action reversal on the 4-hour to get us back into the direction of the major daily trend. Does that make sense to you?